an investor realizes that not doing anything about currency risk is actually taking an investment decision because you're going long that foreign currency, hedge it or not, like it or not.
Hello, and welcome to the Minds and Markets podcast. I'm your host, Jaffer Nakbi. This is our first edition, and what we're hoping to accomplish this series is to take some time and dive into investment concepts that clients may benefit from hearing a bit more richness and depth to. I'm very excited today for the first podcast to have with me Matthew Cote from our client portfolio management team. Welcome to the show, Matthew.
Thank you, Jaffer, and I'm very happy to be joining you today for the first edition of Minds and Market, and we'll be unpacking some information about currency hedging.
Well, perfect. I hear you sometimes talk about synthetics, and you refer to them as the funky part of investment markets, but they can really mean a lot. A lot of people look at synthetic instruments as almost being the tool or one of the tools that was at the root of the financial crisis. But describe to me what you mean by funky, because it's not always just about risk. I think a lot of the ways you work with our clients is not on taking risk with synthetics, but actually about managing and reducing risk. So maybe from your perspective, let's unpack what are synthetics and derivatives and how do our clients on the institutional side use them?
Great you're asking that question because I would say that what I'm passionate about working in the synthetic space is using the toolkit of derivatives, not to speculate in the market, not to increase risk and leverage, but really to better control the risk profile of a portfolio. So we do work with a lot, for example, of large insurance clients in Canada. It can be a large insurer, it can be a DB pension plan. And these DB plans have a fixed liability profile that comes with, the fact that they have to pay out to their retirees over a long period of time. So that liability profile is sensitive to different risk factors. It can be sensitive to interest rate, to inflation risk, and the likes. So what the pension fund do is that they manage their asset aligned with the risk profile of their liabilities. And that's where I would say derivative really comes in handy because we can use leverage to cheaply source exposure to different asset classes.
So topic du jour, then currency hedging. And I need help with this. And so maybe for the listeners, we can maybe go through a bit of a case study because there's different borrowers and lenders and different currency when you're doing a forward to hedge risk. So let's just say you're a Canadian dollar investor with U.S. equity exposures and you have $100 you want to hedge, and I'm the one helping you hedge. What are the mechanics? How do we actually go about synthetically hedging our currency risk back?
This is a situation that we do face with our clients in the Canadian landscape, increasingly so since the beginning of the year. Why is that? I would say, first of all, equity market in Canada is fairly small in terms of the global size of the equity exposure. So the Canadian institutional investor is taking equity exposure in sizable amount outside of its home country. When they do that, they need to sell Canadian dollars and buy the foreign currency in order to be able to gain that foreign equity exposure. And I think that is underappreciated in a lot of...
So if I say it differently, if you're buying U.S. equities and you're the Canadian investor, you have to sell your Canadian dollars, get that back in USD in order to buy the U.S. stocks, which are denominated. So now you've sold your Canadian dollars, you own U.S. now, and that's where the currency exposure comes from.
Correct. And now you're exposed to two risk factors. You're exposed to, say, the S&P 500 return. You also long the US dollar against the Canadian dollar, which is your home currency. So when you calculate your total return at the end of any given time, you're going to want to look at the return on the currency and the return on the S&P 500. In instances where the market, say, is correcting and the currency is falling, you have increased volatility in terms of domestic, local return for your foreign investment. Historically, hasn't really been a problem for the Canadian investor because of the recent weakness, like I would say decade-long weakness in the Canadian dollar against USD, but really against a basket of foreign currency. If we look at long-time historical data, what we tend to see is that negative correlation between US equity and the US dollar. And if you bring that back from the lens of a Canadian investor, that means that historically, you kind of had the natural hedge when investing in US equities without really taking into any measure to hedge the currency risk. Because again, your currency is going to be falling basically when the US equity market is also falling. So that's mitigating the loss that you would have otherwise experienced.
Sorry. So that's because I'll get crossed up. So
Right.
what you're saying is the currency part of the return for the Canadian investor in U.S. stocks goes in the opposite way of the market.
And that's coming from the fact that the US dollar is the world reserve currency. So at times of stress in the market, the US market, but the global market, generally speaking, we see capital flowing into the safest asset, which is US Treasuries, which is denominated into US dollar. So that relationship has been strong for a very long period of time. But there are signs that allude to that relationship perhaps weakening going forward.
And that's what happened with the tariffs, where we saw the U.S. market fall. And what's uncommon is we also saw the U.S. dollar depreciate versus the Canadian dollar. So it's a bit of a double whammy.
And that was a surprise for a lot of Canadian investors when I look at their end of month performance and they see that 18% drawdown that in domestic terms was maybe 25 or 30%, right? So that drew a lot of attention into the currency hedging topic.
So maybe before we dive more into the topic, because I do want to explore a little bit on kind of the dynamics on why that traditional relationship may be at risk going forward, and some of the suggestions in your paper of how investors can tackle it. But I just want to go back to the mechanics of it, because I think it's important in terms of understanding the costs. When I'm putting a currency hedge on, there's interest rate differentials, there's different parties borrowing in different currencies. Can we just walk through the mechanics of how the hedging process actually works?
Absolutely. Once the awareness has come and an investor realizes that not doing anything about currency risk is actually taking an investment decision, because you're going long that foreign currency, hedge it or not, like it or not. So that realization is made. Now, what do we look at in order to decide, how much we're going to hedge? How are we going to hedge? What's going to be the process? What are the key metrics of factors that has to be taken into consideration to better decide what is the optimal hedging policy or strategy? So there's 4 key items that we have to think of. The first one is the cost of hedging. Hedging is not free. There's then going to be the volatility of both the currency, the foreign currency, and the foreign asset you're investing in. Thirdly, there's going to be the correlation profile between that foreign asset and the currency. And I'd say fourthly, we want to understand the dynamic or observe what the dynamic of that correlation profile has been and is expected to be going forward. Are there, for example, any mean reversion property between your asset and your currency? Putting all that together, if we dive deeper into the cost side of things, we've seen a lot of disparity in the central bank interest rate policy lately, and that drives differential in the interest rate between different countries, and that's a main driver of the hedging costs when using future or forward. Why is that? Because the mechanic of hedging currency risk using a simple forward is that we're going to be borrowing in the foreign currency in order to sell that currency and buy back the home currency.
So said differently, you're the Canadian investor in this scenario. you've sold Canadian dollars to buy US dollars to buy US stocks. And now what you're going to do is you're going to borrow US dollars. You have to pay US interest rates for that
Correct.
because you're going to sell those forward to me.
Exactly. You lock the price at which you can sell that currency. That's your hedge. The cost of that is borrowing in the foreign currency. What you sold, now you're going to invest at a risk-free rate in your home market. So you're going to be earning the short-term Canadian interest rate. So when the differential at which you are borrowing against which you're going to be investing is positive, you're going to be experiencing a negative carry. If we take a step back, like before we look into the costs, we should question ourselves, should we be hedging or not? And the main consideration that help us make that decision is we look at volatility. So we have different asset classes, fixed income, equity. Fixed income, much lower volatility than equity. That means that at times, you can have your currency volatility that is much higher than your underlying instrument foreign investment. So in that case, we tend to want to hedge more than not because the risk-return property of your foreign investment end up being dominated by the volatility profile of the currency. And most portfolio managers, they don't have necessarily a view or as much knowledge on the currency market as they do about what the expectation in terms of return and risk is for the foreign asset. So the specialty of an equity manager is knowing foreign equity. Adding too much noise around that knowledge is kind of diluting, if you want, the expected return of the investment. So for lower volatility asset, we're going to want to hedge more. For higher volatility asset, now we're going to want to look at further consideration.
And so I think that kind of gets to why this discussion is on the equity side. So if I'm hearing you correctly, bonds, for the most part, investors tend to hedge that out because you can't absorb the currency volatility with fixed income. Interesting that long run for Canadian investors being invested in U.S. equities, if you're unhedged, you're saying it actually reduced the risk. But now we're in this world where those dynamics may be uncertain. We don't know what's going on with U.S. Monetary and fiscal policy. Is there going to be independence going forward? Does that put a risk to the U.S. dollar? And then at the same time, we're observing the holdings in U.S. equities for a lot of Canadian equity investors is also at a record high in terms of how big U.S. equities are in benchmarks, in terms of how much equities investors are holding. Maybe walk us through this strategic concept you had in the paper, and how can investors cut through the noise and put a game plan in place that's not reactive to currency hedging, but proactive?
So we did look historically at different hedging strategy for Canadian investor invested in U.S. equities. We look at perfectly hedging the notional exposure. We look at not hedging at all. And then we look at what we would say is called a dynamic, more tactical way of managing the currency hedges. And one of the main advantages of that more dynamic approach, and in a nutshell, like, what this is doing is that we spoke about the cyclicality of the Canadian dollar, the Aussie dollar. These are like resource-oriented economies that tends to have a lot of cyclicality in the value of the currency. So this currency will tend to mean revert against the US dollar. And that's over a long period of time. And that mean reversion, if it's stable enough, and we're confident that it will perdure in the future, is something that we can act on. So we're going to want, for example, when the US dollar is strong against the Canadian dollar, to hedge more. And then on the other end of the spectrum, when the Canadian dollar is at close to parity against the US dollar, and parity is as high as the Canadian dollar has been against the US dollar over the past 50 years, we're going to want to go lighter on our currency hedge exposure. And then as the value of the US dollar is mean reverting from, say, 150 at the high back to 140, 30, and lower, we're going to be lowering that hedge exposure and monetizing the mean reversion. One great thing about that approach is that it's kind of mitigating the negative carry of putting on the hedge in the first place that we discussed.
It sounds like investors should be more concerned with where the U.S. CAD relationship is relative to history and is the U.S. dollar expensive more than what is the cost of the hedge. And I think what you're also saying in this approach is it's not an all or nothing, that it's about managing the risk, and the answer can be somewhere in the middle.
Correct. And another large benefit of that a more dynamic approach in the context of the uncertainty that certain market participants have with respect to the US dollar as world reserve currency going forward. So it could be a relationship that's not going to be as strong as it has been historically. I think you alluded to the U.S. deficit, to the rate cut cycle in the U.S. That has already started. The accumulated deficit, the bond market being a little bit wobbly, could lead into a situation where that flight to quality and that natural hedge experienced by the Canadian investor in U.S. equity is weaker. In that environment, you're probably going to want to hedge more to manage the risk of that historical correlation relationship breaking down. And this dynamic hedging strategy is kind of giving you some of that, because when the US dollar is strong, you are actually close to fully hedged, right? So now if you do experience a drawdown at that point in time and the US dollar is not acting the way it's expected, you've managed and you hedge yourself against that possibility.
So in that framework, just general guidance, what would be an appropriate hedge ratio for a Canadian investor today, just given where we are in that long-term cycle?
Again, we don't want to speak to client. We don't know where the market is going forward, but we do look at historical data and we adapt the conclusion that we can get from analyzing that data with the current market environment. So what we see is that we didn't really need to hedge U.S. equity exposure for Canadian because of the natural hedge property of U.S. equity and the currency. But going forward with the balance of risk shifting, it's probably advisable to hedge more.
So start the process. It might be different for everybody, but start
look at your portfolio. What is your view as well about the U.S. economy going forward? We don't think the U.S. economy is not going to be one of the world top economy going forward. You know, this is not where we're at, but I think there are legitimate concern about the strength of the U.S. dollar as well as reserve currency going forward.
And you've made a good point in the past. What you've said is not hedging is also a decision that you're making. And so you have to be comfortable with where everything is, with the amount of unhedged risk you have. So maybe flipping the question on its head a little bit as well.
That's correct. And I think you've hinted that starting the process, you know, we covered 4 key points that help you to begin that conversation or that analysis. We talk about costs. We talk about volatility of your foreign investment asset in your portfolio, the correlation profile, the mean reversion properties. And I would say add one more, you know, it's the current market environment and the global macro environment.
It sounds like taking that strategic approach, though, is the way to do it because it's systematic and repeatable over time.
Correct. Being strategical, being thoughtful, taking that risk into consideration. If you're not hedging the risk, do it with the knowledge. You've taken an educated decision based on analysis that is not something that you deem necessary for you to do, given your risk aversion, given your portfolio construction. And consider as well being a bit more tactical as well. You know, if your investment horizon is shorter, you should be hedging more. Why? Because the long-term property of your historical relationship will not necessarily show over a short investment horizon. For a longer-term horizon, it can be more strategical, but take into consideration the fluctuation, the mean reversion, in order to determine whether combining a more long-term strategical approach with some dynamic tactical shift over time could be adding value to your currency hedging strategy within your portfolio reality.
Well, Matthew, thank you. A lot to unpack in currency hedging. Not the simplest topic to tackle in our first podcast, but one I know is very important to our clients and investors. So again, I want to thank you for joining us and unpacking the world of currency hedging and walking us through some of the thoughts that have come up for the team. I look forward to joining all the listeners again for our next episode of Minds and Markets.
Thank you, Jaffer. It was a pleasure to be with you today.
The views and opinions contained herein are those of the participants and do not necessarily reflect the opinions of and are not specifically endorsed by TD Asset Management Inc. or its affiliates. This is for information purposes only and should not be construed as financial, legal, tax, or investment advice. It is not an offer to buy or sell or an endorsement, recommendation, or sponsorship of any entity or security discussed. Commissions, trailing commissions, management fees, and expenses all may be associated with fund investments. Please read the fund facts and prospectus, which contain detailed investment information before investing. Funds are not guaranteed or insured. Their values change frequently and past performance may not be repeated.